Welcome to another Southbank investment bulletin. I thought I would kick off with the pound. It's up to 128 versus the dollar. So that's a pretty impressive rally. We're back in the region of the 1,000-day moving average. But I think it's important to look at the historical context because back in the 1970s, the pound went down a lot at the beginning of the decade, staged a really impressive rally into the early 1980s, then collapsed into the middle of the 1980s. Then for the next 30 years, it ranged between about 140 and 2. And then in 2008, it collapsed again back to the lower side of the range. Then following, and I guess in anticipation of the Brexit vote, it declined once more and steadied. And then during the pandemic, it took another leg lower. So when people think that this is a replay of the 1970s, they might be justified in thinking so. Because if we think about what is normal for someone who has a middle class lifestyle, well, the first thing is that you don't have to worry too much about what you can afford. And you might not be going out and splurging on luxuries, but realistically, most people expect to be able to pay the rent or pay the mortgage, finance their car, pay for petrol, pay to heat the house and feed themselves and their families, and then afford to be able to go on a foreign holiday once a year. Well, when the pound goes down like it's been going down for the last decade, it's a lot harder to do that because a lot of the things that go into creating that middle class lifestyle need to be imported, and they suddenly become more expensive when the pound goes lower. So then you start feeling like your standard of living is deteriorating because in real terms it is. But when the currency goes up, well, the currency going up, it makes the exports of the UK less competitive, but it also reduces the cost of everything that's imported. So there's a bit of a wash. And then it's really a question, and of course, the long period of time where the pound was quite steady and really quite firm versus a large number of other currencies, then what it really contributed to was the growth of the services industry. Because when you've got a services business, then you don't have quite the same competition on the currency front with exported commodities and manufactured goods because of the higher margins that you have in those businesses relative to manufacturing and the dependence of manufacturing on labor costs. So the strength of the currency was a contributing factor in the development of the services business. Of course, the big shock in 2008 is that when someone said services and UK in the same sentence, well, it usually equated to the banking sector. And the UK banking sector hasn't really been quite the same since the crisis in 2008. For one thing, it's very difficult to open a bank account. And then you have all of these different kinds of regulations that have been introduced, which often feel like they're regulations for regulation's sake and don't really fit the bill in terms of try to mitigate risk. And we saw a great example of that in September, October, when the pension crisis evolved, simply because government bond yields went up and pensions had been breaking the rules. What I think we might say is flagrantly breaking the rules. It was well understood that pensions were taking risks they shouldn't have been. They were breaking the rules. There are clear rules to state that pensions are not allowed to use leverage. They were doing exactly that with leveraging their bond portfolios in order to try and mitigate the impact of very low yields. And subsequently, they needed very swift bailing out. Where was the regulator? And what we have here is exactly an example of regulations for regulation's sake, where there was flagrant misdeeds underway, which the regulator was blind to because they're introducing rules to make it difficult to do business, but not making rules that actually mitigate risk. So there are first principles of good governance, that risk is not a good or a bad thing, but rather that when risks become existential and when instruments that shouldn't be levered are, then that is somewhere where we should see regulations starting to apply. Now let's think about what's going on right now. The pound has rallied and rallied very impressively. So we're right in the region of the 1,000-day moving average. And now we can also see that over the last decade, every time it has come up to test the region of that pink line, it has failed. Or when it has pushed above it, it hasn't held those moves for very long. So we're not out of the woods just yet. But certainly the panicky environment that preceded this rally has ended, and we've pretty much unwound most of the decline, and it's back inside this range that's been underway since 2017. Now, the strength of the pound and the rebound that's underway, not least because the UK government is trying its best to try and reinstill confidence in their abilities to manage the economy. Well, a strong currency is weighing on the foreign earnings or the earnings of international companies. So the FTSE 100 is broadly an international index. And that means that all those companies, and we can simply look at the weightings here, big international companies that are earning the bulk of their earnings from overseas, well, when they redenominate those earnings back into pounds, well, because the pound is so strong, they get fewer pounds. That means that their earnings don't look quite as impressive. So the FTSE 100 looks like it is rolling over in absolute terms. But of course, if we look at this from the perspective of an international investor, and redenominate the index into dollars, well, then the decline doesn't look nearly as pronounced. And in fact, neither does the advance for the time when the pound was really quite weak. Now let's zoom in a little and look at more of a UK focused index like the FTSE 250. And in dollar terms, it has been going sideways for most of the last 6 months, but broadly nothing. So what this really tells us is that from the perspective of an international investor, there hasn't been a compelling reason to be involved in the UK. And until we start to see greater strength and more innovation coming through in the stock market, then there won't be a compelling reason. But I think that there is the potential here that the UK economy will start to attract interest because of its valuations. But that isn't going to happen until we get out the other side of this economic difficulty that the entire world is under right now. And it all has to do with inflation. And I guess the surge of inflation in response to this massive monetary accommodation that we had during the pandemic, this isn't something that central banks seem to be particularly well equipped to handle. Now, we know what they need to do to get inflation back under control, but they're inhibited from doing it. And we can see here that the 10-year yield in the UK is up to 4.65%, and it is now exceeding the peak of the yield back in or during the pension crisis last year. Now let's simply look at Brazil. So let's first just remind ourselves that the UK base rate right now, and it has gone up a lot, but we're still only with a 5% handle. So this is the highest level that we've seen for the base rate in the UK in quite some time, and they have raised rates aggressively. But we're still only about where we were back in 2008, and that was when yields were on the way down. Now, let me just highlight to you that in Brazil, the interest rate right now is 13.75%, and they raised rates exceptionally aggressively, going from 2 to 13.75 in the space of a year, and now they've held it at that level for a long time. Now, the last time rates were at this level was in 2016, so they really cut rates a lot between 2016 and 2020. But then let's just look at where CPI is in Brazil. And this would be just the primary year-over-year measure of inflation. Now it's down to 3.94%, and the trend remains down. So it has come down from 12 to under 4% in the space of a year. And that tells us that if you do raise rates exceptionally aggressively, it will kill inflation. Of course, the side effect of that is that it will cause a great dip in consumer demand, and that is basically what's happened in Brazil. So when we think about what central banks have to do, if they raised rates to 10% in the UK, they would absolutely tackle the inflation problem. The reason they can't do that is because of floating rate mortgages and leverage within the consumer sector. So they have to raise rates piecemeal, and eventually that will bring inflation under control, but there's the real risk that it's going too slow and that it will become entrenched. So then we should also just think about the other big tool that central banks have to bring inflation under control, and it's the size of their balance sheets. When we think about quantitative easing, what it contributed to was asset price inflation. And we saw property prices, asset prices, generally art prices, stock prices, bond prices, all rallying in a period where the volume of cash continued to increase. Then we've also had similar occasions where the volume of cash contracted, and that was quantitative tightening, where instead of increasing, they decreased the supply of cash. And we're in another one of those conditions now. So I created this chart about a decade ago because I wanted to measure the volume of cash sitting on the balance sheets of central banks. And it peaked at the beginning of 2022 in excess of 33 trillion. We're down to 28.5. So we've had a 5 trillion contraction in the dollarized size of central bank balance sheets. And that's a real picture of how much money is being shaved off the global balance sheet. So every time we've seen quantitative tightening underway, whether in Europe or the USA, it has contributed to a deflationary environment. And now we have the ECB, the Federal Reserve, and the Bank of England all reducing their balance sheets at the same time. Eventually, it will contribute to a deflationary shock. Because I guess the reason it hasn't happened yet, despite the fact they've been contracting the size of their balance sheets for a while now, is because of the sheer volume of cash that was printed during the pandemic. And considering just how much money was printed and how much is still sloshing around, then it's going to take time to siphon that money out of the system and to really take the impetus out of inflation. What that is really, I think, suggesting is that interest rates will continue to rise. Eventually, there will be a recession. Then we'll start to see monetary accommodation starting again. The extent to which inflation comes down is going to have a big bearing on just how much money is printed. And that is going to then tell us the real answer to whether we are in a new 1970s style inflationary trend or whether this was a big hiccup after the shock of the pandemic. And I think with that, I'll wish all the best to all of you.